Hi, I'm Munir Sheikh Ahmed, Managing Director, National Bank of Kenya. We've just this morning had a very interesting discussion on the topic of interest rate environment in the Kenyan market. We've tackled quite a bit of the questions raised online. I would like just to clarify a couple of the issues that kept on recurring in terms of the interest rate. One is the issue of why the interest rates charged by Kenyan banks is high. When one uses the word high, immediately the question is how high? So I think what people are really referring to is the interest rate in Kenya in comparison to the developed world. To tackle that question, one needs to understand what drives interest rates to begin with. There are a large number of factors and they interact in a very complicated way. Some macroeconomics, others within the institutions and the sector. The primary one is the inflation rate that exists in a market. If the interest rate is high, it means the inflation rate in that market is high. Therefore, for you to deliver a real rate of return, a positive real rate of return to the fund owner, you have to charge at least a premium above that inflation rate. Therefore, it's unrealistic to expect the interest rate in Kenya to be anywhere near the rates that will prevail in a developed economy where the inflation rate usually trends between 0 to 3%. The second one is, do banks profit from high interest rates? That's again a recurring theme of the questions that arise in the mind of the general public. The reality is high interest rate environment is not welcomed by the industry at all for two reasons. One, it impacts the level of credit that the banks offer because the demand dries up, and the second one is the default rate increases significantly. Both work against the profits as well as the business volumes of banks. So banks are merely reacting to a market force as opposed to driving interest rates higher. So those are the two concepts that one needs to grasp. The factors that drive interest rate, which I've mentioned only one, inflation rate, others being risk-free rate, cost of liquidity, infrastructure costs, the legal costs, the security collateralizing costs, a number of costs that are unique to us as an industry or are part of the macroeconomy and how they interact. The second one is banks not being really welcoming high interest rates. Those are the two issues that I just wanted to clarify. Thank you.